ceteris paribus means basically all things remaining equal, ceteris paribus. Assuming everything stays the same, this will happen.
Which never is the case, right?
No, I don't remember much in my 30-year plus career where everything stayed the same. So it's used in economics to try and isolate all of the various factors so you can explore one part of the model. So it might be assuming inflation stays the same and unemployment stays the same and the economic growth is where it's at, but interest rates move this way, what does that do? So it's an artificial way of trying to isolate one component in a model. And it is an artificial way because everything is literally moving around all the time. They're kind of like pistons in a car. Everything is moving all the time. So you can't assume that any one of those things is going to stay still and the rest is giving you the ability to have that sort of 2020 vision. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at the big differences between what you learn at finance school and what goes on for real in the stock market. Really interesting deep dive here because we all need to have theories on which to base our decisions, but some are more relevant than others. As always, don't just take notes, make sure you take plenty of action. We'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
Gee whiz, am I excited to be here, Mr. B. We've got a fun episode in store. Reason being, we're going to talk about what they teach you at finance school versus what actually happens in real life. This was fairly recent for me, last sort of 5 to 10 years, maybe not so much for yourself, but we can go through some of the topics and the myths that we get told at school that aren't really what happens.
It's an interesting one, isn't it? And it really is chalk and cheese. I remember very, very, very early on, right at the start of my career, you walk in the door with your Bachelor of Science with honours in economics and finance wrapped up under your arm going, I've got this. And then all of a sudden it's like, what's this all about? And
That's right.
Is day and night. And the reality of particularly this industry, financial services and investing compared to that, the theory which you're taught is massively different.
It's funny you say that. I remember I had a person ask me, I just did a subject. It was meant to be the hardest subject at Bond University in finance. It was called financial options and derivatives, options and futures. Derivatives are hard. That's what we trade here. Someone said, so how did that subject help you in your work? I said, it didn't. And they said, really, why? I said, well, because I learned everything on the job. I actually didn't really learn how to make any money out of that subject. I just learned how to do some maths on a piece of paper. And it's true across the board. That's really with most finance subjects.
It is. I mean, the Black and Scholes it's all calculated for you automatically. And I guess, actually my good buddy Shoes, I think, can mentally still do Black and Scholes calculations,
Smart.
but he is an outlier. He's a smart guy. But yeah, that's a lot of the stuff, the theory. And you think, well, I can take some of that forward. And I reckon, and it'd be interesting to see where we arrive at the end of this podcast. But if there was one thing that I think, given the career I've been in, which is, in the trading and investing space and having an economics and finance degree, is that really psychology would be far more important than virtually anything else I covered in my degree. I would say so. And I'm sure we'll wrap that up somehow in the pearls of wisdom we're going to trot out today.
All right. Now, we both have finance degrees, AB, and the first thing they taught me was that markets are efficient. All available information publicly is already priced in. Is that necessarily the case? No. Institutions, insider trading, things going on, right?
Insider trading doesn't happen, obviously, and institutions don't manipulate prices because both of those things would be illegal. I also think you'd be quite naive to believe that people aren't ahead of the curve in certain ways, shapes and forms over time. And markets are reasonably efficient because it is a capitalist machine, but knowledge and that ability, I think, to be at the knowledge frontier is not a level playing field. Stuff that's in the public domain is available for everybody. It's the ability to interpret that, I suspect, which is slightly different. And there are organizations out there that have, I guess, a longer lens that they look through in terms of their ability to interpret that information. Now, if you think about a very, very simple example of this. So if you're talking about Walmart's earnings, we'll just use this as an example, whether it's true or not.
Hypothetical,
hypothetical. So if we talk about Walmart's earnings and the analysts will crunch numbers and go, look, consumer spending has been a bit slower, interest rates have been higher, we had this, there was the pandemic, the Suez Canal, all these different things that they'll be trying to factor in. And as a result, we suspect their earnings may be slightly underwater compared to last year. And there may be somebody else out there, hypothetically, in the marketplace that's just been looking at the satellite footage of the number of cars in Walmart's car parks over the last 12 months. And based on an algorithm of looking at that foot traffic or car traffic would say it's been a bumper year. And they're going to have a very different view of what's going on.
It's like Bobby Axelrod type stuff, this is.
Could be. Bax Capital, I like that.
Yeah.
Might
Mitch Capital, even.
interesting. Time to go.
Yeah.
Need more hair product.
Yeah, I'd say
but,
so.
You know, and that's the reality of information flow and people's ability to then interpret that. So, you know, yes, markets are efficient to an extent, but the way people choose to look through the lens at that, their ability to make predictions based on facts that they have does vary. And also weight of money in markets too can have a monumental impact on things. So a little bit of a rumor here or there and you see money flow out. If we just take something as simple as GameStop, you know, which is 2 years or so ago now.
Yeah.
You've got the ability for the first time where social media and some posts have had the ability to wreak havoc across what would ordinarily be described as an efficient market.
Which it wasn't in that instance, as we know. What's interesting as well, I think point number 2, moving forward from the efficient market, is the views that academics provide about financial markets. And part of this is the theory, as you say, not being as important as psychology. Can we dive a little deeper into that point?
Yeah, like if I go back to when I was at university, I had a couple of really good lecturers that were, one was an industry veteran that had moved into academia, and the lens that they look through has to an extent shaped the way that my trading career has gone. I guess you're at an impressionable age at university, and there were some great nuggets of hardcore real life experience that particular lecturer brought to the table, and I still use some of those things now. And there's another one I can think of that was a very academic in that space with, I guess, less real world experience, whose stuff over time I've sort of challenged in my own mind where I was taught this, and that's actually not what's happening. I wonder why that is, and it leads into that notion of, you know, academia versus the reality of what goes on. And a lot of cynical people out there would say, look, those that can't teach, and that's simply not true. There are some wonderfully talented people, and if we take, you know, Bond Uni as an example, I've done some speaking there, so, you know, I've done and taught, but when you look at the lineup of talent that just, you know, is in the business school, for example, is just insane. They're people that have kicked monumental goals in life and in business, and they're now sharing that wisdom, you know, through the incubators and all the different things that go on there, where that sort of practical know-how is being passed on to students. So sometimes it can be a really good thing too. But I think, you know, university and academia can be very, very weighted in theory, which is what perhaps you need to pass an exam, but that doesn't necessarily mean you're going to pass break even as a trader or an investor. It's
funny you say that, because I remember listening to lecturers not too long ago, those who had experience in, say, trading or financial markets, listening to the theory and how they interwove that with their experience. Then there were some lecturers which were outwardly honest about the fact that they've never worked a day in finance in their entire life. They've been an academic the whole time. Their classes were very much so theoretical based. I could say firsthand, the first option is what gave me the most benefit. When you combine the two, that's where you learn the most.
And, you know, it comes down to personality of lecturers too. And I think if you're someone that's an academic, and that's not to besmirch academics, that's your lane. When you've got someone that's sort of moved from, you know, say the private sector into tuition, personality-wise, typically a little bit more friendly.
Indeed. Speaking of a friendly term, I'm sure you heard this one before. Let's explore this one. Ceteris paribus. They ring any bells, give any nightmares to you?
It does, yeah.
What is it? What does it mean? Okay. And why is it not real? Is it?
It's a lovely Latin experiment, should I say, a Latin expression. And ceteris paribus means basically all things remaining equal, ceteris paribus. Assuming everything stays the same, this will happen.
Which never is the case, right?
No, I don't remember much in my 30-year plus career where everything stayed the same. So it's used in economics to try and isolate all of the various factors so you can explore one part of the model. So it might be assuming inflation stays the same, and unemployment stays the same, and economic growth is where it's at, but interest rates move this way. What does that do? So it's an artificial way of trying to isolate one component in a model. And it is an artificial way because everything is literally moving around all the time. They're kind of like pistons in a car. Everything is moving all the time. So you can't assume that any one of those things is going to stay still and the rest is giving you the ability to have that sort of 20/20 vision on the lens. It's a great way of understanding the concept of if this happens, then this should follow. But that's where its limitation sits. And yet it's something that what was their economic days? Begg, Dornbush and Fisher, which is a massive, thick red phone book of an economic textbook. I remember
Sounds
that.
fun.
And assuming ceteris paribus.
Wouldn't that be nice if we could assume all things equal, but one factor changes, this would happen? We'd all be rich out of the stock market or the bond market, but it's not the case. It doesn't happen in real life.
And it does have its use when you're building financial models. You're just looking at one thing in isolation to build through, and I guess you can layer models on the back of that. But it is a force belief of understanding.
Moving forwards, one other that I heard quite commonly was that the only role of a corporation is to maximize shareholder value. And that may be true in most senses, but is that necessarily the case in real life, AB?
I'd probably say no.
Can we draw on some examples that illustrate that?
Yeah, look, I mean, one of the companies that we put up on the ramp, quite some time ago, and that fairly aggressive dissection of its business has proven to be pretty good, was probably Qantas. So if you think about under the Corporations Act, if you're a director of a business, you've got a fiduciary duty to always act in the best interest of the shareholders. That's very, very clear and outlined in the Corps Act, which is what governs running companies, amongst other things, here in Australia. And yet, there's also an element of self-enrichment that came certainly on the part of the CEO there. And look, just to put that into context, if you took the amount of dividend that was paid to shareholders through the duration of that CEO's tenure, and I think if you look at what their personal remuneration was over the same time frame, and I could be wrong on the number of this, but it's either 10 or 20% of the entirety of dividends equated to what that CEO's remuneration was over that period of time.
A lot of shareholders at Qantas.
And you kind of look at that in terms of a value-add proposition and look at the rack and ruin that the business was kind of left in terms of reputation, customer satisfaction, reliability, age of fleet, just to give 4 sort of hard measures in there. And so, you'd argue that shareholders' best interests probably weren't attended to that well during that particular tenure, yet the remuneration is off the charts in terms of what was earned versus what was delivered. So that's an example, and there are plenty of others where it can go the other way. I mean, I've always talking about Qantas. If you think about Richard Goyder, who was chairman of Qantas during his time at Wesfarmers, and I've been on the record saying this many, many times over the years, I'd argue has probably been one of the best CEOs in Australia. Phenomenal CEO, yet relatively speaking was underpaid versus the immense shareholder value that was delivered under his stewardship. So it can go, that particular ball can bounce either way. So other things that companies can sometimes do is advance an agenda in some way, shape or form.
The corporate governance, ESG, that type stuff? Yeah,
corporate governance under ESG, environmental, social governance type issues. And in particular, if you take something like Bud Light, part of Budweiser, Anheuser-Busch, they very much changed their marketing model to be, let's just say, a little more avant-garde and aware of some of the social trends, particularly the DEI type trend, which sort of swept up the corporate world over the last few years, and it had an absolutely massively negative impact on their business. And you'd argue that pursuing that agenda came at the expense of shareholder value. It's a direct conflict of what should be going on. So I think, there's a lot of responsibility from a board perspective not to be one-eyed about the direction in which you're taking certain things, because there is a possibility that in pursuing a goal that might be more avant-garde and seem to be positioning you as a business in the right way can come at tremendous expense to the shareholders who ultimately are the ones that should be being looked after.
It's funny you say that. I remember when I was at Bond towards the end of my uni days, there was a lot of discussion about, is shareholder value the only thing that a company should focus on? They are arguing that maybe how that company appears in society, what they do for the environment and whatnot, should also be of equal focus. Now, I think if you're a shareholder of a company, most people making that assumption are there with the intention of making money.
Well, there's a difference between being a shareholder and being a customer. Okay, and I think if you have a focus towards how you're seen in society, and this might be an out-of-date dinosauric view, rather like my out-of-date dinosauric university experience, of over 3 decades ago.
We used to it with you, AB, don't stress.
There's a difference between the lens you look through as a customer and a shareholder. So positioning that company or its brand to be this beacon and shining light in society across whatever that matrix may be, that lens may be, may make you want to shop more at that business or become a customer or be proud to be associated with that business. But it's a Pyrrhic victory if it comes at the expense of shareholders who ultimately are the people that have got the real skin in the game in terms of their money, their wealth, their savings, their retirement, their future tied up there. And I appreciate not everything is about money, and you could argue that no, companies have got a responsibility, which they do, to do good work, and they tend to do in the large part. But when that scale, that balance of scales shifts a little bit and CEOs operate the business in the way it's operating as a business for and on behalf of the shareholders, and they're actually looking through the wrong lens, the lens of branding and marketing, that can be a real problem. And I just cited the example previously of Bud Light, and there are a number of companies now that are swinging back quite heavily against some of the social trends that were very much the must, you have to have this if you want to be seen as being part of the club, versus what they're doing now, which is maybe swinging back the other way. Simple example, in Australia, if you look at Woolworths and its spin-off of Endeavour, share price hasn't been anything spectacular as a consequence of that deal. In one way, it became a business that qualified from an ESG perspective, and this isn't a bash ESG, let's be very clear on that. It's just we're talking about shareholder interest here and where it's represented. That move to get rid of Endeavour, which is his grog business, Dan Murphy's, Pubs, Pokies, that sort of stuff, so that it was a cleaner, more socially responsible business. Through one lens, you go, well, what on Woolworths? But if you're a shareholder of Woolworths, okay, you picked up an Endeavour share, but you look at the way your share price has been moving on the other side of the ledger, you're probably not that happy about it because that Dan Murphy's business was extremely profitable. And you could then argue that, well, by getting rid of that business, other than a bit of window dressing or greenwashing, if we were to use that term, is Woolworths any greener? It's one of the largest cigarette vendors here in Australia, so is it really that much more socially aware by getting rid of its grog business? I'm not so sure about that, but that's just my personal opinion. So were its shareholders' interest put right at the very fore? I don't know.
Tough one. Before we dig ourselves any holes, AB, let's get on to our last one here, and that's that history has a tendency to repeat itself.
Bit like our podcast. Do we repeat ourselves?
Yeah, maybe. Is that the case in real life? Because I don't think I've ever seen any one situation the same in the stock market in my years of trading.
I think, it's a wonderful quote. The wonderful thing about history, the one thing we learn from history is we never learn from it. And I've just been in Italy, as you have, a few weeks ago now, and looking at what the Romans achieved, and before them the Etruscans, is nothing short of unbelievable. And you look at them, why did the Roman Empire collapse? Inflation, involvement in foreign wars, spending too much, deficits within its budget. And you go, that's in civil unrest. That's interesting because there's a lot of parallels with the US right now. So there's something that's a couple of thousand years ago we could learn a lot from. What made the ancient empire of Rome collapse? Well, those things. And you could argue the same thing for the US. So when it comes to markets, that is so true. There are always threads that are similar to things that have happened in the past, but they're all unique in their particular set of circumstances. Why? There's no ceteris paribus in the real world for a start.
That's right.
So, if you were to take the COVID correction as an example and then compare that to the GFC, it was a very rapid sell-off. That's something they both had in common. But the nature of the COVID sell-off was really quite different insofar as it was very, very broad-based, whereas the GFC started particularly in financial services, did then contagion across into other areas. If you look at the dot-com boom and bust 2000, 2001, very similar, very sharp sell-off a la the COVID correction in markets, or indeed the more recent sell-off that we've seen across the tech sector earlier this year. But they had different causes, and there were different ways that the stocks actually behave, because not all stocks are the same. The tech sector got sold off, but it was a certain part of the tech sector got sold off, not the commoditized tech, but the stuff that was maybe more focused on, say, AI as an example of that. So they're all unique in what they bring across. And it's fascinating when you look at financial modeling and go, okay, well, when interest rates are cut, this asset tends to perform better, or when things sell off, this is your go-to. Those broad brush approaches typically still work. Times of uncertainty, you can expect volatility to be high, you can expect gold to perform. They're two things that are still true. But there are other nuances within the market because the market's constantly changing. What happened in 2000, or 87, in the 87 crash, let's go back to there. We'd only just introduced the CETS technology for electronic trading. Then you got 2000, 2001, the NASDAQ. First time the NASDAQ had a correction. Technology was faster. That's why the sell-off was more aggressive. Then we moved into the GFC, that was more about the sophistication of multi-layered derivatives that caused that. It's the way those products were developed and the leverage involved with them had an impact. So they're all corrections, but they're all quite different. And the hub of what's happened, why it's happened, and what to do with your money through there shifts a little bit each time. So it's an evolution all the time. That's why it's not a boring business to work in. And I guess maybe that's why. To go back to a subject at hand is, okay, this is what you learn at uni versus what goes on in the real world. The thing in the real world is this constantly evolving beast with new information and new techniques and new minds driving it in certain different ways for new reasons. Whereas, and I don't know this for a fact, this will be an interesting one for us to check out. I bet you if you're still doing a form of economics in the UK, Begg, Dornbush and Fisher will be one of the textbooks that are still getting recommended.
Very nice.
So, going back to my comment at the start, all of those things from a theoretical perspective, everything I learned in my university degree has been valuable to an extent, some more than others, but more than anything, in terms of understanding the way markets operate, is psychology and human nature. And the day you understand that, what makes people tick, how they make their decisions, I think it really unlocks a competitive advantage for you as an investor. Understanding fear, understanding greed, understanding self-doubt, understanding loss aversion, all of those things are human nature trends. And once you get a good grasp on that, it enables you to look at that collective psychology of all investors, which is what we call the stock market.
Very nice, AB. Thank you very much.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.